Subir Gokarn, Director of Research at Brookings India and former Deputy Governor of the Reserve Bank of India, who joins us from New Delhi. Great having you, Mr. Gokarn. Thanks so much for taking the time out. Now, before we talk about the RBI actions yesterday, your take on the US Fed taper of $10 billion. Are you surprised with the timing of the taper in December?
No, I don't think so. I think the macro news coming out of the US was generally positive. There are obviously, it's not a uniformly positive development. There are some points of weakness that are still visible. But broadly, the expectation that had been set up in May, and this is now more than 6 months since the prospect of a taper was first mentioned, at some point it had to happen. So the trigger obviously for this was the fact that everybody's expecting it in September and it didn't happen. That I think evoked a fair amount of surprise and criticism as well. So once you've decided on a course of action, I think it's better to do it to at least show signs of commitment to it rather than keeping everybody on tenterhooks. And the 10 billion was what was expected earlier. They've sort of lived up to that expectation. They've also gone to great lengths, I think, to reassure the markets that this is going to be a very slow process. That the next logical step, which would be to hike rates, is still some time away and a long time away at least. And notwithstanding the change of regime that will happen next month. So all of this, I think, provides comfort in terms of certainty about the way the Fed is going to act, and I think it's going to be relatively non-disruptive, certainly compared to what we saw 6 months ago, when just the fear of a taper, without a clear sense of how fast it would be and how strong it would be, actually led to a great deal of upheaval in the market.
Mr. Gokarn, morning. So your view on the US dollar as well as yields now over the next 3 months, and how do you see taper to impact emerging market flows, because that seems to be the big concern with equity markets?
Well, I think the two levels at which this has to be viewed. The fact that there is less liquidity in the system as a result of 10 billion less being pumped in every month will obviously impact markets across the globe, and it should lead to some hardening. The simple supply-demand dynamics. There's some hardening of yields and some reallocation from equities to debt. That is a logical response to this, but the magnitudes are relatively small, so I don't think the impact is going to be that great. When it comes to emerging markets, I think we're getting back into a situation where there will be an aggregate impact and there will be a country-specific impact. What we experienced in the May-September episode was a very large country-specific impact, which was due to the fact that our current account deficit, our vulnerability, was extremely high at the point. And so the prospects of a currency crash were very significant. Investors were quite sensitive to this and obviously took more money out of India than they did from some other emerging markets. So our markets reflected that. That vulnerability has clearly reduced now. We have seen in the last quarter, for which we have numbers, substantial shrinkage in the current account deficit. The export-import balance is also changing. The last monthly merchandise or trade deficit numbers we have also suggest narrowing. All of these put us in, I think, a relatively more comfortable position vis-a-vis global reallocations than we were 6 months ago. So even though there may be an aggregate impact, I think the country-specific, the country bias will be much less this time around. So overall, I think the impact of this, both from the way in which it's been communicated by the Federal Reserve Board and the conditions that now prevail in emerging markets and India particularly, I think the impact is going to be much less destabilizing, notwithstanding some increase in yields in the US and some appreciation in the dollar as a result of that.
What about our own central bank? Do you think the market largely misread what the RBI was trying to communicate? I mean, when the inflation numbers did come out, the RBI governor came out and said that inflation remains top priority. And he did mention that yesterday too.
Right.
But the action was a pause. What do you think the RBI's actions would be going ahead assuming that the inflation numbers don't come off rapidly is what I mean.
Well, I think the statement was very unambiguous on this, that the risks, the use of the word close call was, I think, very deliberate, that this should not be seen as any indication that the cycle has turned, that the odds are that the tightening cycle will persist, given that the inflation numbers are going to be high. So I think it's a bit of a risk, pausing at a time when all of the trends indicate at least that inflation numbers will remain quite rigid. The rationale that was provided was that there is likely to be a sharp drop-off in vegetable prices, which have been obviously propping food inflation up to very, very worrying levels. Now, if that happens, obviously there will be some softening, some space created. But overall, I think the message was, don't expect this is not a reflection of the end of a tightening cycle. Just a wait and watch, and I think that's the message that the markets need to take. So I don't think the markets misread it, because even if the rates were not increased, the tone of the message was almost as though an interest rate hike was inevitable. And I think if we do see inflation numbers surging in January or remaining quite high in January, we'll have the numbers on the 13th of January or so. I don't remember the calendar because there's a weekend involved there. So soon after that, I think one of the explicit message in the statement was we may not wait until the next scheduled review in the last week of January. So it's a pause, but with with sort of a clear sense of preparedness to continue down this road.
What about the risk that we run of a sovereign rating downgrade? Because besides all the macroeconomics, the high inflation, the fiscal deficit, a big overhang is also the elections and what happens next year.
That's been a risk for some time. It erupted very significantly in 2012 at a time when particularly the pressure from subsidies was becoming very intense. And I think that was a significant reason why we were able to move from a politically charged correction in diesel prices to a more technocratic or automatic correction. The under-recoveries have expanded since their trough before the rupee started to depreciate, but the adjustments are going on at whatever pace is deemed appropriate. I think the signal that's come from the rating agencies is that they have to wait to see what the election outcome is and what the consequences of that outcome for a long-term fiscal strategy are. So in that sense, I think there is some breathing room, although one shouldn't be complacent at all, because it's very difficult to gauge the situation in the last few months of any government's term. Their ability to act, even though the problems are well recognized and the priorities are fully understood, the ability to act is limited. So I think you've got to be realistic about when to expect the change. But that change has to be significant, that change has to be decisive. And if that doesn't happen, then I think the risk of a downgrade comes very much back into play.